high interest rates, shaky economy, and a rising unemployment rate, you would think this market is likely to crash in the coming months. And I'm here to tell you that despite me believing that that is what makes sense, I don't think it's going to happen. And to prove that to you, I decided to pull the last 15 years of data and just start looking at seasonal trends and then compare how 2023 is behaving relative to seasonal trends and to see whether or not this is normalized behavior or not. My name is Vas, and I'm a real estate broker right here in the city of Toronto, and I help investors and families navigate the insanity of our market. Now, in my past and currently, I'm still a chartered professional accountant by trade. I'm not a practicing accountant, but I still know my way around an Excel spreadsheet and my way around data. So without further ado, let's dive into some data and take a look at what is happening and what I think will happen in the future, and then you give me your thoughts. Before we start, I just want to give a quick shout out to Robert here that's on my screen. You can follow him on Twitter or on YouTube as well as TikTok. He's the one that actually compiled and gave me the data to make this video. Without him, there's no way this video would have been possible. And just for those of you who don't know, Treb makes it very difficult to get raw data where you can actually manipulate it and get any sort of insight. He has actually spent a lot of time putting this whole thing together, and he was kind enough to share it. So make sure you follow him. As you can see, this guy loves his charts. They're actually very insightful. So give him a follow, check out his YouTube channel. But anyway, let's get into this video. Now, this video in particular was inspired by the simple question that I get all the time is, how's the market? And honestly, it's very difficult to answer because I don't like giving anecdotes. For me, it's very important. If I'm going to give an anecdote, I have to have some sort of data to substantiate what I'm saying. And when somebody asks that question, it really depends who's asking and what context do I need to provide them with in order for the answer to make sense. In other words, in this video, what I've taken is the typical seasonal trends when it comes to price appreciation during the year. So for example, is this a good time to buy or sell? And obviously, some agents will still say there's no good or bad time. It's always a good time to sell or buy. And I don't agree with that. There's some very, very clear trends in the Toronto region in particular where we have favorable markets for sellers and favorable markets for buyers. I can tell you for myself personally, my best purchases have always been around the dead of summer or in the middle of Christmas. And I have tons of deals to prove that to you. And that's what I think as a buyer, that's what you want to be doing. And obviously as a seller, that is the last thing you want to be doing to get top dollar. So you don't want to be selling in the summer or around Christmas. I will prove this to you with seasonal data, and I'm going to take a look into the years and outlier years that skew the data and to show you that despite all the outlier years, seasonality is still very relevant to the Toronto market. In addition to that, I'm going to talk about listings, where we are in terms of how many listings are on the market and in terms of how many of those listings are being absorbed by existing buyers. And lastly, I will tell you why this market is likely not going to crash because of two very simple things that we can prove with some very basic arithmetic. All right, let's dork out to some of the data. This is something that Robert sent me, and we're not going to be looking at spreadsheets, I promise. This is just to show you the nonsense we have to deal with as realtors. This had to be put together by somebody manually because it simply doesn't exist and it's not available to us. At least I'm not aware of how to get this data. But anyway, let's take a look at some charts. All right, so this is probably going to be one of the more important graphs, and this is to show you seasonal pricing as per the last 15 years of data from 2008 to 2022. Now, the black line is all years cumulative, all 15 years. So as you can see, on average, the market usually grows by 7% on average in the city of Toronto. Now, the blue line is actually, I took out the recession years. So I took out 2008, I took out 2017, where we had the big drop or the rug pull for foreign buyers, and I took out COVID years. And then you can see we're kind of dealing with slightly higher appreciation, so 7.69 if you take out those tougher years. But by and large, the point here is that seasonality trends the exact same way. We usually increase, or prices increase by about 10% leading up to May, starting from January 1st. Then they drop about 4% coming into August. Then they increase about, give or take, let's call it 5%, and then they drop again another 4% to end the year with a net gain of 7%. And this is important because people always talk about prices going up or prices going down without this context. We need to have this as our baseline to understand whether or not the current price increases are in line with seasonality or if they're overperforming or underperforming. So now that you have a very quick lesson on seasonality, I hope this sets the baseline so you can understand everything we're going to talk about after this. So to illustrate my point on seasonality, let's take a look at two outlier years. So the black line is our seasonal norm. So this is what our price appreciation looks like. from January to December. Let's take a look at 2008. It actually followed a similar seasonal pattern, except in September, I think it dropped down. And I think this was around the time where all the banks were collapsing in the US. I think Lehman Brothers, collapsed in September. So that's probably what caused all of this downward price pressure. And then in 2017, we had the massive foreign buyer rug pull, which was a government policy that was implemented around April of 2017, where we had huge appreciation run up relative to the seasonal norm. And then this is how quickly prices dropped. And this looks very similar to what happened in 2022 when the high interest rates started taking place. So this is an example of what seasonality looks like relative to outlier years. Now we're going to do the exact same thing for years, and this builds up the context that we need to kind of analyze what's happening in 2023. So once again, the black line is our seasonal trends. Again, we end the year at 7% appreciation. 2020 is the red line. Coming into March, everything was fine. We were actually trending as per seasonal norms, and then we took a big hit in April, or March 16th precisely, when I think the lockdowns were announced. And then it started slowly climbing its way back up, and then it started following seasonal trends right around November and December. But honestly, difficult year to actually call seasonal because we had multiple lockdowns which impacted selling prices. I mean, it was a big mess. So 2020 was a write-off. Same with 2021, in my opinion. Although it does follow more. So 2021 here, the yellow line, yellow-orange line, it does feel like it's following seasonal trends, but a lot more aggressively. And this is usually normal from when you're coming from a low year. So let's say in 2008, where we had a slowdown and we ended the year with a net negative return of 4% in appreciation. In 2009, I think the appreciation was about 15%. So kind of similar thing happened here. 2020 was rough, and then 2021, we ended up the year with 21% appreciation. And then, as we all know, what happened in 2022, which is the green line right here, we were following similar appreciation path as 2021, very aggressive. And then interest rates, war in Ukraine, all these things took place. Gas prices went through the roof, and we just started sliding right down. And we ended the year negative 20% at the end of the year. So as you can see, these years add a lot of volatility, which overall didn't change the overall trend line much. But I think it was important to kind of disclose this to show you that the last few years were very difficult to gauge and extremely difficult to kind of forecast what's going to happen. So now let's take a look at 2023 and what's happening. Here's our typical trend line for price appreciation, the black line, and the red line is 2023 to date as of May right now. So we started off the year pretty much on par with trend, and then in March there was a divergence where prices started appreciating faster than prior years. And as you can see, from April going into May, really March going into May, it was a complete divergence where, we're 14% where we should really be at only 10% appreciation. So effectively, prices increased by 40% higher than they typically would during a spring market. And I think this is important to justify because a lot of people just say, well, prices increased. Well, what does that mean? Because you could be in a slow market. If prices increased maybe, let's say, only 6% into May, yes, they increased, but they were below seasonal average. So therefore, the market is actually not doing that well. In this case, prices were very aggressive. They appreciated a lot more than seasonal norms. And here's where we are right now. All right, so that takes care of baseline seasonality, and I hope it's very helpful. And I think this is extremely important in order for people to have the context needed so that if somebody tells you, hey, the market's doing great, prices are increasing, well, then you can think to yourself, well, how much are they increasing by relative to baseline seasonality? Because that is the only way for us to gauge whether or not something is good or bad. We need a baseline. Without a baseline, this is just foo-foo dust. We're talking nonsense. So before we get into the second part of this video, if you like the content, if you're finding this useful, if you're learning, please like and subscribe to the channel because that gives me the feedback that I know that you guys are getting value out of this. Because if I don't know, then I don't know what to do. And I want to make sure I'm bringing value. I don't want to be wasting anybody's time. Just like price appreciation and price decreases that have a baseline seasonal norm, there's the exact same thing for new listings as well as sales or absorbed units. So for example, if you take a look at listings, which is the red line, over the last 15 years, typically listings started about 9,000 in January, and then they rip up to about 18,000. And then starting in June, everything drops off, and then the fall market comes back up, they increase again, and then they drop down towards the end of December. Absorption, or the units sold, kind of follows a similar line. So again, it follows similar to the listing. So we pick up towards the spring. In the summer, it's quiet. In the fall, it's a little bit of a flat line here, and then it drops off towards. You can see that the most activity really happens in the spring, and then some again here in the fall, and then it's pretty much dead towards Christmas and pretty much July and August. This is a compounding problem. This is not just a problem of trends, but it's a compounding problem because the more listings you get in 1 month, if they're not sold, they just accumulate into future months, and it creates, like I said, a compounding problem. So let's take a look at the data. So the one reason prices have actually been relatively high and increasing above average, above seasonal average, is because there has been a lack of inventory. And by lack of inventory, in March, I believe we had the record lowest listings for a March since I think 20 years. I think 2003 is where we had such a low amount of new listings come on the market. So the less listings you have, and while the buyer pool is pretty much the same, you have the same people fighting over the exact same properties, and this is how prices get inflated. A similar way to look at the exact same issue, except we are going to look at the cumulative impact on real estate. So for example, the red line is on a cumulative basis how many listings we have by, let's say, May. So by this time, we should have 71,000 new listings. Right now, we've only had 53,000 or almost 54,000 new listings. So that means we're running at about 25% below seasonal trend. Now, same thing for actual solds. So by this time in May, we should have had about 38 or 39,000 sales. We've only had 31,000 sales. That means we're running at about 20% less sales. However, what is important to note here is that these are not running at the exact same pace. So for example, if new listings were down 25%, and sales were also down by 25%, that would mean that prices would have remained flat, or at least should have been trending a seasonal trend, at least in my opinion. But because we're actually absorbing or selling more homes relative to how much lower new listings are, that means that there is a buyer's appetite to actually buy homes. And this is why our prices have been appreciating. So while new listings are down, buyers are also down, but they're not down as much as new listings. So therefore, on average, we actually have more buyers as a percentage to new listings. And this is why the market is so competitive right now. All right, that was a ton of graphs, a lot of Excel, and this is why I'm not an accountant anymore, because even I get bored of all of that. But some very insightful information. So a couple of takeaways from me from the data, and as well as what I think macro is happening and why I don't think this market can crash. And hopefully, I don't know, maybe I'm wrong, who knows. Anyway, absorption. As we can tell, even with less listings on the market and prices being way, way high where they shouldn't be based on the rates where rates are right now, you're seeing massive absorption, meaning that there's still a lot of buyers and there's a lot of appetite to buy homes, even at the current prices with the current interest rates. So that's number one. Absorption is still high. Number two, which is one of the biggest problems we have in the city, is we have lack of housing, or lack of supply of housing, between red tape, bureaucracy, and the fact that we're only building investor grade condos, which is, I think, the biggest asset class or whatever we're building right now. There's no supply, yet we keep importing people here. I think we're breaking all kinds of immigration records, which again, I have no issue with. I'm an immigrant myself. My parents came here in 96, but if you're going to bring this many people and not do anything about the supply side, I mean, this is going to continue to artificially inflate and keep our prices high. And a recent stat that I just saw is that Canada is number 6 in the world when it comes to where high net worth individuals go. So we're number 6 in the world. So that means we're attracting a ton of high net worth individuals into this country. And guess what these high net worth individuals are doing? They're parking their money in real estate. And that is pretty much how I see the real estate market here. Now, the good news, and I guess I'd call it good news, is that this is all self-inflicted. And the reason that is good news is it's within our control, because we have created this. And by we, I really mean our government, because no matter which variable you look at, every single one is the direct reflection of poor government policy. That's it. Whether it's immigration, whether it's lack of supply of housing, whether it's red tape, whether it's trying to get a permit in the city of Toronto, no matter what, it's at some sort of level of government, whether it's municipal, provincial, or federal. And that's how I see this issue. And until something meaningfully changes at whichever level, I don't think anything is going to change on the ground level for us citizens. And because of that, I do believe, unfortunately, housing is going to remain where it is. And I don't think it's going to get any more affordable into the future. Hopefully I'm wrong, because I would like to see some affordability. I don't want this to become a city of haves and have-nots, but that is unfortunately the divergence I'm seeing right now. But like I said, it is self-inflicted and it's a reflection of our government. I hope you enjoyed this. I'd love to hear your thoughts on what you think, and I'll see you in the next one.